this crisis brings a lot of opportunities, actually, because what was happening was we had very concentrated portfolios. We had very concentrated market, right? It was basically led by the U.S., very low volatility. That was the asset class to be in, and it built, and because of that, we had very concentrated portfolios. Now, because we're a little bit more balanced, we're going to be able to use that volatility to implement better portfolios, more effective portfolios across the world. And what that really means is that the portfolios coming out of 2020 are going to have a lot more asset classes in them. And that's really what we're looking to do right now, is we're looking for opportunities to change some of the portfolio weights that we had that were concentrated or a little bit higher to more of a diversified profile. We're looking at these opportunities to include downside hedging strategies. We're looking for opportunities to include alpha strategies. So getting away from the usual beta ETF saturation in our portfolios to more diversified portfolios going forward. And that really is the key to this year. In 2020, we're going to be building portfolios that last the next decade.
Walk me through that, Paul, in the sense that, obviously you want to do this in some kind of cost-efficient way. And it's something that we're actually seeing happening here in this part of the world as well, as we see sovereign wealth funds looking to, basically buy low at such an interesting time for the markets, and certainly with companies in the United States. What does this look like specifically for you guys?
Well, so in the next month or so, in the last month, it's been about following the flow of, or the expansion of the COVID-19 virus, right? So it started in Asia. Markets had just gotten flow back into Asia before it hit, and so the flow went back into U.S. markets and Europe. And then the COVID-19 started moving there, and at that point we were risk off on the U.S. market in particular. So we were putting our hedges on, getting out of beta, and then moving back to Asia and to enjoy some of its recovery. And because right now we're at a point where things are still uncertain, right? We haven't tested as much as we can. We haven't assessed the market potential impact of COVID-19 in the way that we can. We still are not sure about how much stimulus we need, even though the governments have been quite progressive in providing that stimulus. So uncertainty is something that we have to compress right now. So we're looking at markets where they have compressed that uncertainty. And we're looking at Asian markets because they've done a very good job in containing that uncertainty and containing the virus, or seemingly containing the virus. So where we see opportunities and where we're putting on opportunities is, or taking advantage of opportunities, is in Asia. We are seeking opportunities in the U.S. as well. We're starting to now. So as we see dips, we're starting to buy on dips, but always protecting that downside. And just another stat to give you right now is the amount of put protection that's being bought is far more than was bought in the 2008 financial crisis, meaning that investors are still quite fearful of the downside to come, even at the point where we are, where we're saying that we're kind of reaching a plateau. So there's more volatility to come, but that leads to a lot more opportunities as well.